Welcome to our 5-step guide to insurance for self-managed super funds. If you are setting up a self-managed super fund or SMSF, this information is essential. Your first step is to understand why insurance is important to your SMSF. As an SMSF trustee, you have a legal obligation to consider the insurance needs of your members. This requirement was introduced in 2012 after the Cooper Review into Superannuation found that only 13% of SMSF members had insurance. The majority of Australians have insurance through their super fund. This means if you transfer your super to a SMSF, you may lose the insurance cover in your current super fund. Not all members will need insurance depending on their stage of life, but you will need to document that you have considered their need for insurance and taken out cover for them if required. The Insurance Needs Calculator on our website can help you with this. Your second step is to understand the types of insurance which can and cannot be owned by your SMSF. Only certain insurance covers can be purchased under superannuation legislation. This includes life insurance, TPD insurance with an any occupation definition but not own occupation TPD, income protection insurance with basic benefits but not comprehensive or agreed value cover. Under no circumstances can trauma insurance be owned by your SMSF. This type of cover must be owned personally. You can learn more about the different types of insurance on the Insurance Watch website. Your third step is to weigh up whether the insurance should be taken out through your SMSF or personally. Some of the benefits of paying for your insurance from your super fund are: you save cash flow as the premiums would otherwise have to be paid out of your pocket. You may pay less tax because your contributions to super are taxed preferentially at 15%, and your super fund can claim a deduction for the insurance premium. However, some of the disadvantages compared to owning your policy personally are: the insurance premiums will reduce your super balance and therefore your eventual retirement savings. There are limited beneficiary options under super. There may be tax payable on death benefits paid to some beneficiaries such as adult children. There may be tax payable if you are paid a TPD lump sum under the age of 60. Your fourth step is to find out how much the SMSF insurance will cost. It is important to find this out before closing down your existing super fund. A new insurer may refuse the cover, or the cover may be more expensive or have exclusions depending upon your current health, occupation, pastimes and family history. If this is the case, you may need to maintain some funds in your current super fund to preserve the existing insurance cover. Insurance Watch provides a free online comparison service comparing quotes from a range of insurers, including the largest life insurance companies in Australia. You can compare not only quotes but benefits too for up to 3 insurers side by side. Bear in mind that not all benefits will be available when a policy is held by a super fund. And using Insurance Watch, your SMSF will receive a 10% cash back on the premium in the first year. Your fifth and final step is to work out how to apply for the insurance. Your application for SMSF insurance needs to ensure that the policy is set up correctly by 1. Listing your SMSF as the policy owner. 2. Listing all trustees, or if the trustee is a company, the directors of that company. 3. Paying premiums from the bank account of your SMSF. 4. Obtaining signatures of all SMSF trustees or directors. And 5. The person to be insured will need to complete a health statement. On Insurance Watch, this can be completed via an online application, a telephone interview, or a paper application. Unlike a personally owned policy, you will not be asked to provide beneficiaries for a death benefit. This is because the insurer will pay the death benefit directly to the SMSF as the owner of the policy. To make sure that the funds end up where you want, it is important that each member registers a valid beneficiary nomination with your SMSF. Under super, there are only limited options for nominating beneficiaries. It is also a common misconception that a super death benefit will automatically be included in your will. This is not necessarily the case. When no beneficiary is nominated, it will be up to the SMSF trustees to decide who to pay the benefit to. Insurance Watch will help you with the paperwork required to set up the policy. After the policy is in place, we can provide the insurance documents required by your SMSF auditor. And most important of all, if a claim needs to be made under the policy, Insurance Watch can assist you to achieve the best outcome. Go to the Insurance Watch website now and select Compare Quotes to get started.